Venkata Mahesh has written in from Bangalore. Dhirendra, he's 33 years old and he wants you to help him trim down his mutual fund portfolio. He has a time horizon of 15 years and he's been putting in 3,000 rupees in these funds, across these funds equally. The first on his list is the UTI Opportunities and UTI Dividend Yield. They're very different, these two funds, but does he need to have both of them with his time horizon?
Yeah, he should have both of them in his portfolio, and both are completely different kind of portfolio. Both are reasonably impressive fund, and they continue to be impressive even now, and they're good complementation to each other.
The next list is from the HDFC band. There's HDFC Prudence, HDFC Equity, Top 200 and Mid-Cap Opportunities. Again, it seems to be a lot of duplication across the board. Does he need to have all of them? Prudence might not be very useful with his time horizon. Neither will HDFC Top 200. What would you recommend?
Likewise, I would agree completely with you that these two funds, maybe, even HDFC Mid-Cap Opportunity, which is proving to be a very impressive mid-cap fund. Likewise, HDFC Equity. So these two things complement each other with a little, with a very marginal overlap. And if one has these two funds and a good part of your money getting allocated to these two, then one can well drop the HDFC Prudence, because that is a balanced fund. 30% into fixed income. You are looking for a stable, growth with stability. And likewise, HDFC Top 200, you don't need it. And given that you're investing for next 15 years.
The next on his list is ICICI Prudential Discovery, Focused Blue Chip and FMCG. Does he need a specific exposure to the FMCG sector, Dhirendra, considering the rest of his portfolio is equity diversified?
Most equity fund, the kind of fund which he's holding, they are overweight on FMCG. And given that, in these times FMCG is driving the market or looks expensive, it's a very, many investors actually look at, past performance, and they chase past performance. They look at that and, the best funds doing well. Maybe his FMCG fund will do well in coming months and year, but it is an undesirable thing to have, because one has to look at the portfolio performance on an overall basis. There will be a period when FMCG will be out of favor, because most sectors, or everything in the market is cyclical, and being into a concentrated vehicle is undesirable. The goal should be to diversify, not to concentrate.
Diversify, don't concentrate, which means that the next two funds, Reliance Pharma and Reliance Banking, won't fall into that category. But Reliance Banking is a very good performer, Dhirendra. What would be your recommendation on these funds?
No, following the principles, because today if you think in terms of adding a banking fund, you are taking a deliberate bet on banking. And if you look at all his existing funds, all his other funds, there the top allocation of his money, he is exposed to banking to the tune of 25% of all his money getting invested by virtue of investing in those funds. So that is the average allocation of the diversified equity universe. So having a banking fund on top of all this is only exposing you to greater volatility.
Venkat Mahesh, so that's the advice you're getting right now. You don't need to have a sector-specific fund in your portfolio, especially since your equity diversified funds are going to be investing in that sector anyway. We have a question from Akshay Mani, Dhirendra. He tells us a friend of his told him that if he invests a lump sum amount in a liquid fund, it will be safe and give him more returns than a bank fixed deposit or a bank savings account. Now, he wants to know if that's true, because he has about 10 lakh rupees to invest. What would you recommend?
Yes, his money will be reasonably safe. Of course, his money will not be as safe as his savings bank account, but it will be almost close to that safety. Because the way liquid funds are structured, we have not witnessed any decline in value even on an overnight basis. That is one. The other is that in recent times, the norms for liquid funds have been devised in a manner which further reduces the likelihood of liquid funds going down in value, because they are not allowed to invest in any security with a maturity of over 91 days. And the likelihood of getting more return than a savings bank account, yes, for now one can expect nearly 1.5 times or more return than a savings bank account return. But not only this return comes it comes with high liquidity too. You can actually invest a large amount of money and get your money back in 24 hours credited to your account from a liquid fund.
If you said for a short term it makes sense, but for the long term, would a liquid fund still make sense, Dhirendra?
No, for long term it does not make sense, because for long term, if it is many, many years, then you should be thinking of equity. So liquid fund will make sense only, large amount being invested by an individual will make sense only in case where you want to buy a house, you have your accumulation. There is a possibility that the money will be needed in 7 days, or while you're searching for your house, it just might take 6 months. In those cases, that money can lie there in liquid fund. Else I don't see a reason why your long-term money should be in liquid funds.